And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, another powerhouse in the mutual fund business, getting into the ETF business. Let's talk to Holly Framstead. She's the director of ETFs for Capital Group, which owns the American funds, and my old friend Dave Noddick from ETF Trends. Holly, Capital Group set to launch its first 6 ETFs tomorrow, all of them actively managed, all launched down here at the New York Stock Exchange. Capital Group's relatively latecomer to the ETF space. Can you tell us why now?
Yeah, thank you so much, Bob. And I actually believe our time in market is just perfect. We don't launch funds very often. And when we think about bringing a new ETF or a new vehicle to market, it's really about listening to our clients and understanding if we can deliver on their expectations in the vehicles that they're asking of us. Recent regulatory change has meant that we now believe we are positioned to package Capital Group's time-tested, actively managed strategies in the ETF vehicle. And so when we think about the products that we'll be listing on the New York Stock Exchange tomorrow, we'll be bringing 6 funds to market that really fit a majority of the major asset allocation building blocks. They're designed to sit squarely at the core of a client portfolio and ultimately simplify the investment process for countless financial advisors and end investors.
You know, when I look at these, they're very much like actively managed mutual funds that you already run, but not quite. There's a little bit of difference. There's 3 equity strategies that invest primarily in the U.S. You've got 2 equity strategies that cover international and global, and you've got a fixed income core plus strategy. But they're a little bit different than the mutual funds. How are they different? And why don't you just clone them into the ETF space like some other mutual fund providers already have?
Yeah, it's a really important question, I think, particularly as we've seen the ETF industry evolve. And I'll go back to the investor, because really when we think about product development, we really take an investor first mindset. And what we heard from our clients is that they were looking for expanded choice from Capital Group. They wanted more ways to access our time-tested strategies to access the capital system. And so we chose to launch ETFs that would complement, not clone our American funds, because in the end, we believe that that's bringing greater choice to the market.
You know, Dave, in a world where many of these ETF fund groups are focused on the shiny objects you and I cover all the time, like thematic tech, Capital Group is doing something different. They're sort of sticking to this actively managed core strategy. What's your thoughts on that?
Yeah, I do think it is a differentiator here. A lot of the active management we've seen has been, as you put it, shiny objects, thematic tech, clean energy, things like that. This is really active at the core. And for a lot of advisors, this is something they're pretty comfortable with. What you were saying, Bob, I think is very interesting. You know, you can go out and buy Growth Fund of America as a mutual fund. Every financial advisor in the country can do that. It's on, practically half the 401k plans in the United States. However, these are different, right? They're interesting ETFs at the core. And, because they're ETFs that aren't direct clones, it means that it can take advantage of things like some of the tax loss, the tax lot management that ETFs can really benefit investors with. And it also means that they don't have to worry quite so much about liquidity issues. So I think there's a lot here for folks to grab onto. I think it's worth pointing out, too, that these are coming in pretty cheap, right? I mean, I think the weighted average expense ratio is a bit under around 40 basis points. That puts it in the bottom quintile of actively managed equity ETFs, right? 400 of the 500 active ETFs we have in the market right now that are tracking equities are over 50 basis points in fees.
Yeah, Hallie, what about those different fees here? So I'm looking at the fees you're charging here for some of these. There's 6 of them, 33 to 54 basis points, it looks like, for these actively managed ETFs. But these are all lower fees than you're charging for the mutual funds that are out there. Are you at all concerned about that competition you're setting up with your own funds here? These are cheaper, as Dave points out.
Well, I think an interesting point is when we think about pricing our products in the market, we're focused on the competitive landscape. And as an organization, we have had a legacy of delivering very low-cost active management. We strive to be in the lowest quartile among peers with every product that we bring to market. And so with these ETFs, we will be priced in the lowest quartile and some even the lowest decile among competitors in this space. Our mutual funds and our ETFs are priced actually very similarly if you look at kind of common share classes here. So we don't believe there's a very big disparity here. And again, when I think about the ETF, it's about increasing choice for clients that prefer the vehicle. We think there's a place for both mutual funds and ETFs in our client portfolios.
And you're choosing to stay in the core active management space. I'm just intrigued because Dave and I love covering shiny objects, thematic tech and things like that. But things like factor investing, for example, another sort of differentiator out there. But you're sort of sticking in this core space. Is that because that's where you feel your competency is, or those other spaces are too trendy, or maybe that'll happen in the future? I'm just giving you a sense of where you're going to go with Capital Group in the ETF space.
Yeah, so I think there are a couple interesting trends for us to look at here. First, while a majority of the news that talks about ETFs is focused on, Dave, what you call the shiny objects, where we look at investor flows and really client demand, it is for those core solutions in a portfolio. When you pair that with the fact that Capital Group's legacy is delivering core investment services for our clients, we believe that we can package what we do best in this vehicle and actually be a differentiator. You're right, these aren't intended to be shiny objects. They're intended to sit at the core of a portfolio. And at the end of the day, I think what that accomplishes is it helps financial advisors and individual investors cut through the sea of complexity and choice that's available in the ETF landscape and really get back to basics at the heart of their asset allocation process, which is really what matters most.
So,
and
David,
Bob,
go ahead.
I was just going to say one thing that we should point out here is that this is sort of the last of the big managers to enter the ETF space, right? I mean, they're one of the only $3 trillion plus manager out there that hasn't been in the space, right? Roughly the same size as Goldman as an asset manager, or JP Morgan, folks that have been in the space for quite a while. So that means they're coming to market with an audience, right? There are folks out there who are avid believers in the Capital Group process, right? That combination of individuals and teams working together. That's not a new idea. This is a 1930s idea that's just finally showing up in the ETF wrapper.
Yeah, and it seems, Dave, like there's a lot of different motivations for fund families to get into the ETF wrapper, and we're seeing that, here today. They're not always the same. Elaborate on some of these different motivations. You think like the main concern would be you want to make sure that you still have people who are coming into your family overall, and people are into the ETF space, but it's not just about making sure you're maintaining market share, right?
Well, I think for us, it's about recognizing that we can expand the clients that we're able to service by offering our strategies in the vehicles of choice for them. I think that there are a number of existing Capital Group clients for whom there are taxable pools of assets where they'd appreciate the ETF as a vehicle of choice. We have heard from our investors that they would like to add to their investment with Capital Group via increased vehicle choice. And if we look at how we've developed and brought new services to market in the past, we had a similar experience with separately managed accounts, where when we launched the separately managed account business, what we found is that financial advisors that invested via SMAs with us actually subsequently did more mutual fund business because we were offering choice in how they accessed our strategies, and that made us a more relevant partner for them in their businesses. We believe ETFs will enable us to deliver the same to our existing clients, and then also, of course, expand access to clients for whom the ETF vehicle is preferred.
Right. So you're known for active management. American funds are famous for that. And these are all active management. But as we've talked about before, the bulk of the money in ETFs is still going into the passive strategy. Even now, in the first 6 weeks of 2022, the bulk of money is still going into passive strategies. Look into the future. Is there any consideration to getting into the index space where a lot more money, maybe it's not as profitable, but a lot more assets under management are potentially available?
Yeah, so I'm actually going to reframe your statistic because I think that there's a bit of a confounding effect here. A bulk of the money in ETFs, I believe, are going to core solutions. I think investors in the ETF vehicle are really looking for those core building blocks. A majority of those have been indexed. So certainly we've seen assets move toward index management, but I think it's investors speaking to where and how they want to allocate money versus the investment style. So when we think about Capital Group's 90-year legacy of delivering above market returns for our clients, we really believe that active management is at the heart of who we are as an organization. And that's why our entrance into the ETF marketplace is really squarely focused on active management and not index management.
Yeah, and Dave, I guess Holly's right if she considers like an S&P fund, a core fund or a core investment strategy, because that's where still most of the money is going at this point. Can you just characterize some fund flows for us in the last 6 or 8 weeks? Because I'm getting that question all the time. Where is the money going?
Yeah, so I mean, it has been going to that core, right? We haven't seen a dramatic shift here in the last 6 weeks that we saw last year. About 10% of the money is going into actively managed products. That's about what we saw last year. We're running at about something like 15 billion year to date into active ETFs here. So, really, I think this is a stick to your knitting kind of market where we've seen a lot of folks allocating in. We haven't seen really dramatic shifts in the flows picture that would make you think, for instance, that everybody's running for the hills or everybody's piling in and buying the dip. It's been pretty consistent. That actually, to me, feels very, very healthy.
Yeah, I think the important thing, Holly, is you are now firmly established in the ETF space, in that core space. And the question here is, now that you've got that core built around you, where else can you go? Are there other, I know I've asked you this before, but are there other ambitions? You're such a big company. It seems like there's natural room for you to move and breathe a little bit more here. Now that you've got these core ETFs that are out there, are you going to simply stick to that strategy and just manage those 6 right now? Or are you going to do like, Schwab did and others and just try to expand out from there and see what the market is like?
Yeah, so the 6 ETFs that we'll list tomorrow are absolutely our entrance into the marketplace, but this isn't where it ends for us. If you look across the services that we are launching in this initial suite, they cover a majority of the largest asset allocation building blocks, but not all of them. All of the equity services have a roughly large and mid-cap universe to them, and we only have one fixed income offering in this initial suite. So we anticipate, again, continuing to listen to feedback from our clients, continuing to take feedback now that we're out in market, and respond to investor needs. And so I expect that the product lineup will continue to expand, but we're going to take a very patient approach to that and ensure that we're incorporating new product development with the lens of an investor in mind and incorporating their feedback.
And how do you respond to this age-old debate of active versus passive? We all know the studies. We've seen the S&P studies that come out, the SPIVA annual reports, that over long term, most active fund managers do not outperform their benchmarks, certainly over long periods of time. 10 years, 85% don't outperform. Well, what do you tell the naysayers? You're famous for active managers. You've been around a long, long time doing this. What do you say to the naysayers who say, well, frankly, the evidence is just staying in the index fund is probably a better long-term strategy? How do you respond to those arguments?
I think there are a lot of valid ways to invest, and Capital Group, with our fundamental bottoms-up selection process and our multiple portfolio manager system, has a 90-year legacy of delivering superior investment results for our clients. So I think our track record really speaks for itself, and that is why we have a loyal investor base of $2.6 trillion of assets under management. So I think there's a place for both active and index in a portfolio, but really at its core, we believe that we can deliver actively for our clients and have a track record of doing so.
Yeah,
well, Holly,
and Bob, remember, we've got
ahead,
800 actively managed ETFs now, right? I mean, that ship has long since sailed. It's roughly a quarter of the industry.
Yes, and we keep talking about the year of active management, Dave, but we did that in 2018 and 2019, and we did 2020 as the year of ESG, and we're constantly reproclaiming the year of active management here, and we're going to retire, you and I, on that idea that 2025 is the year of active management. But I watch the fund flows, not the number of funds, and you do too. And you still see where the bulk of the money still goes. The debate goes on. You and I have been talking about this for many years. I love active management. I think it's very important for people to have choice, and I agree with Holly completely about this. People need choice, but you and I watch what goes on here and how difficult it is to outperform the market. And there's very fundamental reasons why it's difficult to outperform the market. But Holly, I'm pleased Capital Group, as Dave said, you're one of the last holdouts, that big fund family getting into the ETF space, and I want to congratulate you and Capital Group, and we look forward to having you on again in the future. Thank you, Holly. And that's it for this week's ETF Edge. My thanks to Holly and to Dave. Now, I've asked Dave to stick around to chat a little bit more about ETF trends for the ETF podcast coming up. We're going to talk about whether the bloom is off the rose for ESG funds. Haven't talked about that this year. And other trends to start 2022. Dave is the master of trends. And remember, you can see all of our shows on our website, etfedge.cnbc.com. See you next Monday, same time, same place. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.